Good evening, everybody. Thank you very much for joining in. This side, Rahul Magan here. I am speaking on behalf of Treasury Consulting LLP, which is a limited liability partnership firm incorporated in India. This company dealing with multiple revenue streams. We are having multiple domains, and as you understand that we are having a brand which is foreign exchange basic thinkers. So this brand is syncing with millions of people across the globe, and one of the part of the brand is our YouTube channel, and on which we are posting a lot of videos about foreign exchange, business valuation, and respective topic. As you're very well aware that in the last few weeks we have started posting the personalized videos, and this is one part of that. And today we are going to speak about very interesting topic, which is known as options moneyness. We heard this from a lot of sources, but somehow or not we are not convinced exactly what do you mean by option moneyness, what exactly it is, how it moves, how it happens, and so on and so forth. So let me elaborate what option moneyness stands to you people. We all heard about options. Options is a derivative instrument. Unfortunately, there is a great myth in the market that it's a forward contract which is also a derivative instrument. Excuse me, forward contract is not a derivative instrument, it is an option which is a derivative instrument, right? Now, how option behave? When it comes to moneyness, there is again a myth that the moneyness of the option contract can only be in exotic option. Now, first of all, we'll take a small break here and I'll explain what do you mean by an option contract. An option contract is a derivative contract in which you are having a right to decide at what rate you want to take an option contract. That is known as the power of moneyness, right? Moneyness refers to a situation or a concept whereby you are always be in the money. But nonetheless, so there are two kind of options across the globe. Number one is the deliverable options. Now, what do you mean by deliverable options? Deliverable options are those options wherein you will deliver your INR and you will deliver your foreign currency, which in majority sense is dollar, and you will get your INR. On the other hand, non-deliverable options are those options wherein you are not going to deliver anything, neither you are going to receive anything. So, and at the end, the net settlement would happen. You are going to do the net settlement. But nonetheless, options is of two types, which is deliverable option contract and non-deliverable option contract. Now, this deliverable and non-deliverable would further be categorized into two parts. Number one is your plain vanilla. Number two is exotic. Now, what do you mean by plain vanilla? Plain vanilla means buy put and sell call. On the other hand, what are exotics? Your range forward, your seagull, your straddle, your call spread, your put spread, and there are so many. You just name it and you are having the series of that. But how you would compute option moneyness, or what makes option the best derivative instrument vis-a-vis the forward contract, which is option moneyness? Now, from where option moneyness came from? Option moneyness is a kind of not a situation, but it's a kind of benefit or plausibility which an option trader would always have to decide at what rate they want to take a contract. So let us take a very simple case. Suppose you are Infosys. You know that you are approximately $9.5 billion company, and you have to take a forward, you have to take a hedging program, or you have to hedge your receivables and payables. You again very well aware of the fact that since you are Infosys, which you have to do 9.5 billion, so you have to do a rolling hedging program. In rolling hedging means it might be rolling quarter, it might be rolling monthly, it might be rolling semi-yearly, it might be rolling yearly. But what all derivative instruments you are going to cover with that? You would have forward contract, you would have option contract, you could have range forwards, you could have straddle, you could have strangle, you could have seagull, and there are a lot of kind of contracts which you might be having. Now in this, how to decide the rate at the rate at which you are going to take a forward contract? That is what moneyness is all about. That is something which you have in your hand. On the other hand, when you comes to forward contract, there is not a single time when you can decide at what rate you want, or at what rate you really interested in having a forward contract, because the forwards do not have the moneyness. Only options would have the moneyness. Whether it is a deliverable option, it's a non-deliverable option, it's a plain vanilla option, is an exotic option, you are having the concept of moneyness in place. Now, moneyness in nutshell, is a situation when a corporate treasurer is having the power or the will to decide at what rate he wants his contracts. Option moneyness will divide it into three parts. Basically, moneyness will divide it into three parts. Number one, in the money, at the money, and out of the money. If we go via number terms, then I am writing here for you. You can very well see that, but first, before writing, let me explain to you. This is at the money. This is at the money, which you can see here. This is in the money, and this is out of the money. Now, in the money would further divide it into two parts: deep in the money and in the money. On the other hand, out of the money will further divide it into two parts: deep out of the money and out of the money. Now, what is at the money? If I go as per the number line, option moneyness is between 0 to 1. Let me elaborate the size so that you people can see very well. Right. Now, at the money is having 0.5 delta. In the money is approximately 0.75, some people will say 0.8 delta, some people will say 0.65 also delta. Deep in the money, as per the books, this is having 1 delta. No, deep in the money do not have a 1 delta, but yes, it is very close, roughly 0.9 to 0.95 delta. Out of the money is approximately, I would say, 0.4, 0.45, something like delta. And deep out of the money is having, say, not 0, say 0.10 delta. Now, what is delta? Delta is a Greek. It is a Greek of, it is an option Greek. Now, delta is, this is delta for you. Delta is change in options pricing divided by change in underlying. That's delta all about for you. You have gamma. Next, gamma is change in delta to change in underlying. Then you have theta. These are option Greeks. Change in options price because of change in time. Then you have vega. Vega stands for volatility. And believe me, when I am referring to vega, I am referring to implied vols. When I am referring to vega, I am referring to implied vols. So this is change. I am not referring to historical vols. Change in options price divided by change in implied vols. Then you have finally delta, gamma, theta, vega, you would say RHO, PHI, you have delta, gamma, theta, vega. Unfortunately, I am not been able to recall the fifth, which is one is PHI and an RHO, which is a risk-free interest rate. Let me write here PHI and RHO. These two are different nonetheless, but let me explain. Change in options price to change in risk-free interest rates. So these are few option Greeks, and option moneyness is all about delta. In fact, one of the beautiful concepts which option moneyness will give you, something which forward traders do not have, that even forward traders will always has their position counter position using option contract, which they do not have is the delta, because delta is a change in the option price to the change in the underlying. Unfortunately, forward do not have that, but nonetheless, let me summarize and move forward. Option moneyness is a concept which will allow a corporate treasurer to decide its price. Option moneyness is divided into three parts, like I explained here, which is at the money, in the money, out of the money. Now at the money would always have 0.5 delta. Not to mention in the money would have 0.75 delta. Deep in the money roughly 0.9 delta. Then you have out of the money and then so on. In the money would divide it into two parts. Deep in the money and in the money, and out of the money will divide it into two parts, deep out of the money and out of the money. This is how it works. This is how option works. But if you are acting as an option trader, how would you compute this? How in realistic situation you would value this? You don't know, right? How you're going to value this? So here is an example in that regards. Now what are you going to do? We have taken this example. Let me increase the screen size so that people can see, I make it to 170. Now we assume that sitting today USD INR spot rate is trading at 70. USD INR spot rate is trading at 70. So 1 USD is trading at 70. Please be note that I am not taking bid and ask here. So I am not going to make it more minutely that this is the bid, this is the ask, this is the bid ask spread, or this is the bid ask differential, and so on and so forth. I have made it minutely. I am not making it minutely. So what I did, I said that sitting today the spot rate is trading at 70. Wow, INR is already trading at 67.25 and it will move higher. There are a lot of expectation that INR will move higher. But nonetheless, that's not here. That's not something we are going to discuss here. Right now, we assume that the 1 year forward premium is trading at 5 rupees. So what would be the outright? Here we go. Outright is nothing but sum of spot plus premium. That is moneyness come from. Can you change the rate in a forward contract? No. But you can change that rate in option contract as per your situation. Because in option there is one thing which is premium, and option moneyness would impact your premium. So in forward contract the rate is agreed which is 75, which you cannot change, right? Now I assume that the 1 year implied vols is trading at 10%. Now please note carefully that once you calculate the moneyness, always take implied vols. Please do not take historical vols. There are three kind of vols here. Let me guess. Let me write for you. One is historical volatility. One is implied volatility, and one is realized volatility. Historical volatility we all know. It's all know that is standard deviation, right? Implied is equals to historical. I'll write this: historical volatility minus outliers. There are some traders who tend to believe that historical volatility plus outliers. So that is their wish, how they want to take it, how they are going to take it. So that is something. Some people will add outliers, some people will remove outliers, so their call, right? Now realized is actually the current vols which you have plus minus expectation. So one trader is expecting that INR will move to 70, like me. One trader is expecting that INR will stick to 67. You have a lot of people. One trader will believe that no, INR will go more higher. So it's vary from trader to trader. But nonetheless, let's start with an example. I projected that current INR spot rate is 70. 1 year forward premium is 5 rupees. Outright would be 75. Here you go in front of you. I assume that 1 year implied vol is 10. Yes, it is 10 because currently it is trading between 9.5% to 10%. So what I did, I took it flat on the 10%. Now here I assumed it is an implied vol. Okay. Now how option moneyness would come? How it is going to help me? What I am going to do? I have, what is at the money? Here is at the money. What is 1 year at the money? Something which you are getting in the form of the forward premium as a forward contract. So sitting today, 1 year forward contract is traded at 75. My at the money is 75. One is what is in the money for exporter. What is an exporter? Exporter will always talk about buy put, right? Let me write here. He will talk about buy put, but it's my duty to explain you what do you mean by buy put here. Buy put is nothing but a derivative contract which will help you to sell at an agreed rate. There are many people in the industry who will say that buy put is nothing but a kind of insurance derivative also. I may not differ with that. But buy put is a kind of where you will fix your rate. So suppose today INR is trading at 67.25 and you wanted to protect your position, so you will go ahead with the buy put contract. This is buy put for you, right? Now in that options derivative contract, in the options derivative contract, we are going to calculate in the money. What do you mean by in the money? See here carefully. At the money plus one vol. Implied vol is known as vol. Standard deviation is known as vol. Please look at the formula. At the money plus one vol. There are many people who are using 0.9 vol. There are many people who are using 1 vol. There are people who are using 0.8 vol. So vary from people to people, but I always use 1 vol. So in the money is, at the money plus 1 vol. If I say using a technical word, I will say it is 1 vol away. I will say it is 1 vol away. So it is something 82.50. Then I will say deep in the money. Please look at in the money plus 1 vol. In the money plus 1 vol, which comes here, so roughly 90. Now how would I explain this? If I take the buy put at the money, I have a right to sell my forward contract, my option at 75. If I do in the money, I have a right to sell at 82.50, but remember carefully, I need to shell out lot of premium. Premium will go up, right? I will make it here. In this situation, the premiums would be like this. Premiums would be like this. And in case of deep in the money, the premium would increase. So your risk management policy should have the guts to take it a huge amount of premium cost in your books. But all those who are thinking that premium is a big game, please remember carefully that this premium is subject to amortization or capitalization. So you can capitalize this premium, because here in this example we are talking about a derivative contract which is 1 year away. So today is 6th of August 2016. You are taking a forward, you are creating a position for 6th of August 2017. Now since you are creating a position 6th of August 2017, so this is 1 year away, so you can capitalize that in your books. So you will divide this premium into 12 parts, and every month you will keep the premium in your books, and the rest premium would continue to be in your balance sheet. Then comes out of the money. Like we have treated in the money is going to be out of the money, but on the reverse side you would have at the money minus 1 vol. So here you will pay the impact. Here you will receive an impact of vol. Here you will pay an impact of the vol. Now since you pay an impact of the vol, you would be having a rate of 67.50. All those who are watching our video, note carefully that options, especially buy put, is always taken on out of the money, and when it comes to buy call, they are always taking in the money. Because if buy put is taken at in the money, you would have to shell out a huge premium. On the other hand, if buy call is taken in the money, then again you have to shell out lot of premium. Out of the money you have to shell out lot of premium. So what you are going to do, you are going to take buy put. You are going to take buy put at out of the money, and you are going to take buy call at in the money. Now here comes deep out of the money. Here is F2. Listen carefully again. Out of the money minus 1 vol away. Now in terms of buy put, this is exporter. This is, let me write here, this is importer. Some people can change this also. So if I am an exporter, I can do this, I can do this. If I am an importer, I can do this, I can do this. Now last but not the least, you can use these in terms of following derivative contracts: buy put, you can use this in buy call, you can use this range forward. Range forward exporter is nothing but buy put and sell call. You will find several videos on our YouTube channel pertaining to range forward. You have range forward importers, you have range forward exporters, and you have Seagull. Seagull exporter means buy call plus range forward exporters. Seagull importers means buy call plus buy put plus range forward importers. This was all about. At the end, we would like to summarize the fact that if you are a corporate treasurer, like I acted as a corporate treasurer for an American company for 10 years, then I left and started my own company. It's always advisable for you to take an option contract, then a forward contract. We all very well understand that forwards, we all understand that markets are getting highly volatile. And in this volatile market, we don't know, anything can happen. We saw Brexit. There are a lot of talks which are on the way, which suggesting that there are a lot of European companies might exit, European countries might exit European Union. So we don't know how the things would move. So it is always advisable to take an option contract. Although you will find several school of thought in the market who will continue to stick to forward contract. Before winding up this video, I would like to suggest one fact here, that if you take an option contract, please don't think that you have to take all the premium directly into the P&L. No, you can capitalize that premium. You can capitalize that premium at a very by the time you not been able to, the particular period is not coming. With this, we thank you very much, and you are always welcome to contact us at treasuryconsultingllp@gmail.com. Our alternate email IDs is rahulmagan8@gmail.com. My contact number is 9899242978. With this, we are taking a goodbye from you, and a lot of videos on the way. The upcoming video for today is how to hedge masala bonds. This is something very good, and I hope you find it very interesting. Thank you very much and have a great time ahead.